Good morning, everybody. Welcome to the Pure Exposure Growth Series live stream. I am your host, Iaccino. Extremely excited to be here. This is our first live stream, and we are live, by the way, hence live stream. We've got markets rolling. We've got news out of China overnight, which I think is a little bit ridiculous, but we'll get into that in a minute. We've got markets up on the equity side of things. We got commodities up. So there is a lot to talk about. You are being exposed. This is Pure Exposure. I've got with me right now Scott Shellady, who is the founder and president of the Cal Guy Group. Scott, thanks for joining me.
Good morning.
Again, we have live markets right now, but before we get into that, we're going to do a little educational segment. So I want to educate people watching about who you are, what you do, and what's with the cow print.
Well, I've got a long family history in the business. My father started in 1962. We've got a family farm, and in the early 70s, in order to bring some more exposure to what he was doing and make sure that folks didn't think that he was gambling for a living, it wasn't Macau or Las Vegas. He wore a Holstein print jacket on the floor of the exchange at the Chicago Board of Trade in the old days to attract attention that we're actually serving an economic function and setting price. So it wasn't just fun and games, it wasn't just gambling. And lo and behold, when he retired in 2001, I started wearing the jacket. And at the same time, a lot of media and money came into the business, and I kind of got stuck in the crosshairs, and here I am. So, 15 years later on the media side and 31 years later in the business, this is what you get.
What's a Holstein?
A Holstein's a black and white cow that generally gives milk, right? Well, only female cows give milk, but it's the female Holstein that gives it.
So it's not what you put your gun in.
No, exactly right. No.
Joining me as well on Skype, two of my good friends, two really good traders, Scott Bauer, who is the president of Prosper Trading, and Mike Arnold, who is the chief technical strategist at Path Trading Partners. Scott, let me start with you. Again, you've been in the business a long time. We've known each other a decent amount of time, but tell people watching what it is you guys do and what your specialty is.
Yeah, so my background is trading in the equity markets. I was on the floor of the CBOE forever, let's call it. And,
you look great.
I really, what's that?
You look great.
Thank
you. Don't look as old as you are.
I've really come to, hone my expertise in trading volatility. So, I brought those skills that I traded on the floor forever and built Prosper Trading Academy, and we teach people how to trade live in the markets.
So, Mike, we've known each other a really long time, right? It's an interesting story between me and Mike. Mike actually signed up to learn one of my strategies and then walked up to me and said, I have figured out a way to improve your strategy. And because I'm not as arrogant as I appear on TV, I said, well, tell me what you did. And he did improve on my strategy. So we started working on things together. Mike is the chief technical strategist at Path Trading Partners. Mike, what do you do? What's your specialty? What do you focus on?
I focus on technical analysis, testing systems, systems development, and refining different systems using both your strategies, my strategies, and the strategies I've developed with funds over the years.
Yeah, it's funny because Mike signs these like non-disclosure agreements with these funds he works for, and I can't get him to disclose things to me. He actually sticks to the non-disclosure.
Well, that's a good partner.
I don't know
There you
if
go.
he does or not. But so what we want to do in this first segment is something, Scott, I'm going to go to both the Scotts on this, but I want to talk to Mike here about something that we want to get into before the market open, and that is proper risk management for outright trades. We're not talking about options, we're not talking about condors. This is just something that Mike and I have noticed over the years in talking to people, I'm sure you guys have as well, that a lot of traders don't understand risk management from the perspective of position sizing and what that does to a portfolio. So I'll have people call me up and say, do you have a tip? I don't have a tip generally, but they'll say, oh, I'll just buy $10,000 of that. And it's like, why are you buying $10,000 of that one thing? Or why do you stick to 100 shares? So Mike, I want to start with you on this, and then I'll bounce off Scott as well. In terms of risk management, position sizing, money risk, what's the most important thing in your opinion?
Well, we define our risk on a per trade basis, and we adjust our position size to make sure it fits within that. So we adjust our contracts or number of shares we're trading because we know where our entry is, we know where our stop is, and then we keep our risk parameters constant. So constant risk per trade by adjusting our position size.
So the reason for that is this way one trade doesn't affect your portfolio. I mean, Scott, you've been through this. You do a lot of institutional business, and you hear like a trader get completely crazy over one particular trade. And I actually stood next to you for a little while, and I remember you going, I don't know why this one trade bothers him so much. Is this something you talk to institutions about, or you get it back from them?
No, I mean, what I've learned over the years from those institutions and some from guys, losing their minds periodically, is that a lot of times it's better to have a portfolio where you can afford to have something go a little bit, haywire, and the rest of the portfolio, having that portfolio brings down that volatility, right? And that's something that Stottlemyre, for anybody that studies him, would say. So the more things you have in there, that lessens the volatility, and you can express your view in a safer, more steady way.
So, Scott Bauer, options. Do you use them as your focus to manage risk? Both? How do you use them? And is position sizing something you talk about?
Yes, yes, and yes. So that is my focus. I mean, I'm rarely actually trading stock. I'm trading options instead because I think there's a bigger advantage, much more leverage using options. So that's my focus. However, yes, everything is risk defined and risk managed. And what I teach my students is I typically allocate somewhere between 3 and 5% per trade that I make. Okay, keep that allocation though consistent. That is the key. If you're at a 3% level, great, keep it consistent. If you're at a 5% level, great, keep it consistent. And like Scott Shellady just said, that way you have a position on, and there's no reason that 1 or 2 positions should ultimately, give you blowout worries or really affect your positions that much. And then, we're constantly adjusting as well, but constant risk allocation, keeping it consistent, that's the key.
So we're going to put something up on the screen right now. And this is a trade that Mike and I were talking about yesterday. It's moved away. And although we're coming up on the market open, we've got about 13 minutes before the market open. So I want to put this up really quick and show this sort of risk example of what we mean by the position sizing. So yesterday, there was a little bit of weight to the market, right? And in that particular area that the S&P happened to be in, we were thinking about selling the S&P. We didn't end up doing it, which is fine. But what we have up on the screen right now is a risk example for E-mini. Now, this is an example. This is not an actual trade, all right? This didn't happen. We're not doing it. But let's say you have $10,000 of risk capital, right? And you say, I want to sell the entire market. I've got a portfolio. I want to keep it. I want to stay long, but I want to have some sort of a hedge, or even if this is a speculative position. So if the contract is the ES, and let's stick with what Scott said, risk per trade 3 to 5%, right? So we've got a 5% risk per trade. On $10,000 risk capital, that's $1,000 risk per trade, right? So how do you manage that? Well, if our entry price, which is what we were looking at yesterday, which I'm glad we didn't do, is shorting the S&P at 28.87, and if our stop price, again, if you're looking at price action, your stop should come from the same place your entry did. In other words, if you get a price action entry, you should also have a price action based stop. It shouldn't be based on a dollar amount, and that's what a lot of people don't know. They'll say, I'm going to sell the S&P and I'm going to risk $1,000. Well, if the S&P volatility is spiking, which we've seen lately with trade wars and with other things going on, Brexit and the Italian situation, we see volatility spike. That means your normal range is widen out. So you have to widen your stops out, and the way to keep your risk consistent is to shrink your position size. So in this example, the tick value is 1250 a tick in the ES. So the number of ticks at risk is 220 if you're entering a short at 28.87 and stopping it out at 29.42. That's 220 ticks on the S&P, right? Position size for this particular account is 0 because the risk on this trade is $2,750. That's more than double the risk of your 5% of risk capital. Now, the other thing about going, what I like what Scott Bauer said about the percentage of risk capital is that as your capital increases, as you make money, you're risking a little bit more. And as you lose money, you're risking a little bit less. So what's the thing that traders always talk about doing? Just staying alive for the next day. So Mike, on this next one we're going to put up is the new micro E-mini contract that the S&P, or that the CME group came out with, right? Now, the CME group put this particular contract out for this particular reason. So if we put up that micro E-mini example, it's going to essentially be the exact same trade, but when you scale it down to the micro E-mini, you can now do 3 contracts because the risk is $275 instead of $2,750. Same exact trade. So this is what we mean by position sizing. So Mike, if you're looking at this particular example, right, and you have that in a blanket portfolio, do most people shrink their position size or do they move their stop? And what's the point of doing that? Or rather, why is that not the point?
Well, most people tend to move their stops so they can just squeeze in the trade, or they don't have to really adjust their positions. As they might say, I'm always trading one or two contracts. And so they just adjust their stops to say, okay, now it fits into my risk parameters. And what you did, which is using the new CME group, Micro E-mini, is you shifted down to a smaller contract, which enabled you to keep your risk within the $1,000 per trade. And you at 3 contracts, 3 times 275 risk per contract is below $1,000.
So that's kind of the point we're trying to get at, Scott Shellady, is if you keep your risk defined to that percentage of your risk capital, you can have 20 trades on, you can have half of them be right and half of them be wrong. And if your risk reward is always 1.1 to 1 or greater, I should say reward to risk, it's,
There you go.
I mean, you can't say you're not going to lose money, but over time, that ends up building your portfolio up. So from a perspective of what we're showing here, is that something you've seen with your institutional business? They're always calm about that? Or do they get cowboyish every now and then too?
No, I mean, I think that the longer they've been around, the less cowboyish they are. I mean, and to Scott Bauer's point earlier, I mean, really all you're preaching here is a system and sticking to it, which equals discipline, right? That's all it is. And I think the discipline is the key word, because we're all human and we tend to do something kind of crazy every now and again. But the guys that have been doing it a long time are also the most disciplined people. And, you know, it's really easy to enter a trade, but the discipline comes on the exit of the trade.
Right.
And anybody can get in, but it's very difficult to get out and get out well. And I think that's what this is all about.
Yeah, and that's part of what like Scott Bauer does with his options and what we're doing here. You can get slippage on a stop, but if you know this particular trade is $275 of risk, and you know that's the trade that you allocated, the only time you're thinking clearly about a trade is before you get in it. So I've been doing this 26 years. You've been doing it how long, Shelley?
31.
31. Bauer, how long?
28.
Mike?
27.
27. I still want to touch a trade when I put it on. To this day, I still want to. And that's probably
Yep.
the biggest fight day to day. And that's what something like this does. If you have 20 trades on and every single trade is $1,000 risk or less. Remember, this particular trade, $275 per contract, 3 contracts. So it's within that $1,000 range. Using a method like this, if your max risk is $1,000, you're generally going to be below it. You're never going to be above it. Because if you're above it, it's no trade.
Right.
So I'm going to use a statement I've used ad nauseum. Mike's heard it before. Scott's, I don't know if you have. There's only 3 results of a trade: a win, a loss, or a break even. 2 of those are good. 2 of those results are good. And a break even is the same as not entering a trade that has too much risk. So that's really.
Bob,
Please.
can I interject here?
Yeah, absolutely.
Building on what you said, building on what Scott said also, easy to get in the trade. It's getting out, which is difficult. And in a trader, retail, whether you're day trader, retail, whatever it is, you have to understand that losing is part of the game. And that is the hardest thing for people to accept. Nobody wants to lose, even by a tick. Nobody wants to lose. But the successful traders learn how to manage their losing trades just as well, if not better, than managing the winning trades.
So let's go into that actually, because we're looking at a trade now, right, in the S&P. So rather than put up the minis, we're going to put up the micros. So we're going to put up a chart of the ES. It's the same price, right? So we can put up a chart of the ES, but we're actually going to affect this trade into the micros and show people how it's done on the Power E-Trade platform. So what we're looking at here, actually, Mike, why don't you go into what we're looking for, since this is kind of your trade here. What are you looking at in this particular chart?
On this chart, we have a sloppy double top formation, which is actually just confirmed a few minutes ago.
I'm glad we're on
And
the
now
internet,
it's
because that doesn't sound like
rallying
something you say
back
on
on
TV.
a 5-minute chart into a concept. We have a rotation zone, so we have a confirmed double top on the shorter term chart, and it's actually trading against major daily resistance against the 50-day exponential moving average, which has been in the vicinity of recent resistance. So we're looking to get short this right around these levels, and then put a stop up above 29.45 and roll it into a nice daily trade.
All right, so we're going to do that in a minute, but first I want to talk about opinions on this trade. How do you guys feel about shorting the S&P? Let's talk about the news that came out this morning, right? We had Chinese officials, I think it was the Commerce Secretary, who said basically, we don't want the trade war to accelerate, right? Now, my opinion, I'll give that first. I feel like saying no shit, but like, you know what?
You just did.
Well, thank you. Do we have a delay? We don't have a delay. So, from my perspective, like, who wants the trade war to accelerate? Like, is this a reason, Scott Shellady, for the market to rally as much as it has?
No, but I mean, that's the world we live in today, and we're going to go on and on with this. I mean, my personal opinion is I don't think we're going to get a resolution to this. We might have to, plan our lives at all. The delta of this happening at all, not happening is 20% in my mind. Mm-hmm. We might not ever get a trade deal with them. This could go on another 18 months. The supply lines change, and away we go. I mean, I don't like that, but that could also be an outcome here because we're dealing with somebody that has nothing to lose, right? Don't pick a fight with those people, okay? But number two is that the bond market's telling us that this is a good trade, right? Because look at the work the bond market is doing, and I like the bond market because it's so much bigger than the equity market, and generally, to me, it's the truth serum. This is a short-term voting mechanism, and that's telling me that things aren't that, the bond market's telling me that things aren't that great, and that would lead me to believe or lend me to do a trade like this rather than get behind the euphoria.
So 2-year, 10-year spread more inverted, Scott Bauer, than it was yesterday. At least the last time I looked at it. We got live markets going on, so it could have changed. We had the 10-year last time I looked at it about 148 or so, and the 2-year about 152 or so. I mean, I could be wrong on exactly what it is.
Yeah, I think it went to 6 basis points yesterday, actually.
On the inversion?
Yeah.
Okay, that's good to know. Let me ask you a question. Scott Bauer and I did a TV interview, and this is going to sound like an I told you so, but it's not. Scott and I did an interview where he said there's only going to be one rate cut, and I said there was going to be more. But this is what I don't like about financial TV, right? And 3 out of the 4 of us are on all the time. Mike is kind of like a reclusive giant brain. But 3 of the 4 of us are on TV all the time, and they say, what do you think? Okay, great, we'll have you back to talk about that. And then you're not back on for 3 weeks, right? So has your opinion changed, Scott, in terms of what the Fed not should do? Okay, because that's not valuable in my opinion. What will the Fed do? Will they react?
So again, I'm glad you just separated that should and would.
They're different.
They will react. They are going to cut rates again. Do they really need to? I don't personally think so. Yes, when you compare what's going on here globally to the rest of the world, and you look at negative interest rates in much of the rest of the world, one could make the argument that our rates need to be lowered. However, if you're, depending on the data that they are looking at, that we're looking at, we're moving along pretty well here. And with the stock market at, near all-time highs here, and the 10-year around 140 and the 30-year at all-time lows here, to me, it just doesn't make sense that they need to lower rates. However, they will lower rates.
Okay, so with the 2-cents yield curve spread that we have, we're going to put on this micro E-mini trade after the break here. We'll be right back. Stick with us. We are back. Thanks for waiting through that commercial. I got to show you guys the S&P up here again. There's the micro E-mini S&P, and we're right in the area where we want to set up this trade. So what we're going to do is we're going to enter into a trade. This is a trade Mike and I talked about. Scott Bauer, I didn't ask you about this, but let's put it on first. We want to short the micro S&P. Okay, again, that's the smaller contract, right? And we're going to try and put in a sell at about 29.16 or better. Right now, it's trading about 29.1650. We're not stressed. I'm sorry, about 29.1550. We're not stressed if we don't get the trade. This is the point of setting a trade up. But we're right on the market. We'll probably be pretty close. So we're going to go ahead and sell a micro E-mini at about 29.16 or better. And then we're going to place that stop in that we mentioned up at around 29.45. All right, so if we get that stop in, we get the trade in, we'll have the trade in place, we'll have the stop in place, and we are not going to touch it. We've got a target in mind. We'll hope to get out of this thing at a profit before the show's over. So this is how you're doing. We're putting it into the Power E-Trade platform right now, and we'll be talking through it as the trade happens. Order is sent, and we're going to wait and see if that fills. So, Scott, what do you think of what we're doing here?
I love it. I mean, I would maybe give it a little bit more time frame. I know we want to have that stop order out there, and we have it just, a point or so above here. But I'd want to give it a little bit more time frame, because I think that when the equity market opens here in almost 10 minutes, you may see a little bit of a pop.
Right.
But I do expect a sell-off. So, I on this one, I may give it a little bit more room on the stop, only because of that. What's that?
Go ahead, Scott.
So you got me, right?
Yeah, we got you.
Can you hear me? Okay, good. Yeah, so I'd give it a little bit more room. Or even I would wait maybe 8 minutes here till the market opens to do that. However, I love the short here. On the option side of things, I'm looking to buy a put spread in SPY, so I love it.
So it looks like, Claire, correct me if I'm wrong, it looks like we got this, right? I think we did. We're going to put that up and take a look. Yep, open position there, so we're good. So we got this trade. Now, Scott, let me ask you, Bauer, from a perspective of what you're saying about you might get a pop off the open, is this something you're seeing chart-wise, options-wise, something like that, or is this just your experience on the open? Which is it?
Yeah, this is more just of a gut feel, and the reason I say that is because since the GDP number came out about an hour ago, which was right in line and really has not affected the market overall, the Dow has, I'm looking right here, Dow's off about 40 points from its highs. Looks like S&Ps are off maybe 3 points from their highs. I would expect that you're going to get some buying coming in of people that don't have access to the pre-market that want to jump on this rally. So maybe it's more of a feel, maybe it's more of an experience type thing.
All right, so this is a good thing because we've got the trade on, we've got the stop in place. So now we're basically going to wait. We're going to see what happens on the move on the open. And let's kind of shift gears a little bit here and talk about some of the earnings we got this morning. Scott Shellady, we got Best Buy this morning. Best Buy had a 9.1% surprise, right? They had revenue, which they jacked up a little bit. The street was expecting about 99 cents, 108 on the EPS. What do you think of Best Buy just in general as a company?
Well, I mean, I think that obviously those earnings are good, and that's healthy for the economy going forward. I think, like we've spoken about in the past, they don't really have as much of an opportunity to spread out any, say, tiffs, tantrum throughout other products. So that actually probably is healthier than it really is. Mm-hmm. But going forward, if they can do that well in this environment, that means that they'll do really well once that environment either solidifies or it gets better, because it's not going to get any worse, really. It's a full-blown trade war, if you ask me. So I think that's pretty healthy.
Scott, what do you think? And then I'll go to Mike on the charts. But what do you think about Best Buy like as a company?
I love this report.
Okay.
And if you really delve into what they said, numbers were really good. However, they're being cautious because of what's going on with the trade war. All of their metrics, they're coming in right in line with analyst expectations, kind of middle of the road. They raised guidance a little bit here, but the stock is selling off because I don't want to say they raised a red flag, but they're being a little bit cautious. So the pre-market trade here, you can see the stock down to a major support level. I'm looking here, and we can see the stock is trading down around 65-ish.
Yeah, we're seeing it on the screen here, down about 5.43% the pre-market right now.
Yeah, there's a lot of support. There's a lot of technical support in the 64, 65 range. I think that is a great opportunity to get into a longer-term call spread, to some upside here because of that support. And quite frankly, their release was not too bad. It was cautious, but it really wasn't bad.
Mm-hmm. Mike Arnold, what are you seeing on the chart on Best Buy?
Yeah, there is major support. I completely agree. I mean, there's support all the way down to, the 62 area. So anything in here, between 62 and 65 is a great support zone to lean against for establishing a long position, especially going into the holiday season.
So Shellady, you like how well they're doing with the current situation, but we might get new tariffs. You don't think there's going to be a trade deal. Do you think it's kind of going to just be status quo and they're going to continue to do well? I mean, obviously they're in a segment, right? They're in electronics. So are they moving the supply chain? What do you think?
Well, I think the smart thing to do is to start to look at that, especially after what the president said last week. Not that that's going to be an edict or a law, but there could be a small delta on the chance that this doesn't ever come to a resolution, and slowly but surely we start those supply lines elsewhere. And again, if they like what Scott said, yes, they were cautious, but cautious and still coming through with the results ultimately will lead to something good happening. And if they can continue to do this in this environment, well, the environment's only going to get better. Either we get a deal or the supply lines change and we get a deal. And so that would make this even better.
Let's talk a little bit about the consumer if we could, because we had another stock that had earnings. By the way, I want to point out to everybody, you notice we're not staring at the S&P, right? We've got our trade on, we've got our stop in, that's it. Do I look nervous? I don't feel nervous. Anyway.
You look like Nathan Lane and Eddie Munster, kind of.
Oh boy.
I want to actually act like Eddie Munster and look like Nathan Lane. Dollar Tree, Scott Bauer, a 4.2% negative surprise. Now, we have a strong consumer, that's without a doubt. Is Dollar Tree doing poorly, because Dollar General isn't doing bad, but is Dollar Tree doing poorly because the consumer has money and they don't have to shop at a dollar store? Or do you know of something? I mean, you tend to dig into these earnings reports. I don't know if Dollar Tree is one that you dug into or not.
It is. And I look at some of these, off or lower end retailers, Dollar Tree, Dollar General. Look at Five Below as well, who have reported earnings. And all these stocks are up this morning. Mm-hmm. So the consumer is doing well. And the consumer is doing well, in my opinion, from the mid-level on down. Not the luxury brands, but mid-level on down. So the Targets, Walmarts, Kohl's, all the way down to the off-brand, or the lower end retailers, and it's hard to fight that. And again, yes, cautionary, right? Because a lot of the supply chain, especially in that space, comes out of China, so cautionary. But until we see signs of the consumer slowing down, I think this is a good space to be in.
Lord & Taylor sold for $75 million. They used to have purses in there that cost $75 million.
Yeah.
So, I mean, some of the older retail's dying, right? Mike, the Dollar Tree stock, the chart. What do you see on the Dollar Tree chart?
Well, our Vantage Point AI software has been long since the 16th of August. And this morning on this run-up with the earnings announcement, it actually ran smack dab at the end of one of our advanced clear path moves at right around 106.50. So it's already hit our key resistance. It's pulled back a bit since then. So that's why we also have targets on our trades, because we go in knowing where we're going to at least scale out part of it before, just as we know where our stop is, we also know where targets are. So it's essentially manages itself. And it hit the end of the advanced clear path this morning. So on the earnings pop.
We got about a minute to the open. We're going to probably lose Bauer for about 3 or 4 minutes after the open because he gets busy with his clients. So, Scott, anything you want to point out before the open? You got about 50 seconds.
Yeah, again, watch the S&Ps here. I mean, we're back to up 28 points here. I'm looking. Dow's up 258 points. I would look for a little pop on the opening, and any opportunity there to sell is I'd be all over it.
Again, talking about, we're not going to talk about this stock specifically. So, Claire, you don't have to put this one up, but Burlington Stores as well. 18.3% surprise to the upside. So again, consumer, Shellady, right? I mean, can the consumer bring manufacturing out as we wait for the open here?
Yeah, I mean, they're 70% of our economy. Mm-hmm. I mean, that's a behemoth. You can't ignore that. And if, bottom line, if the consumer is healthy, and you know what? Consumers are also starting to save more. Mm-hmm. So it's not like they're really overextending themselves. So all of those signs, to Scott's point about maybe not having to cut rates, you would say no in that environment because they are doing so well.
That's one behemoth pointing out another behemoth. Let's put up the E-mini S&P just for the open. And again, it's not going to change what we did. We put the trade on. There's the opening bell. We're going up a little bit, which you would expect. A little bit of a sell bar there. Don't care, because we've got our trade in, we've got our stop in, we've got our risk defined. That's where we're at on this particular trade. So let's talk a little bit technically, Mike, about a couple of the others that we're looking at here. Abercrombie and Fitch, that's ANF. I'm
Opening
going to put you on
bell.
the spot and ask you to do something there while I talk to Scott about the last time you shopped at I was just there.
Oh, yeah, I bet.
Myself.
Well, because they sell that stuff in a medium, by the way. You know that, right?
I like smalls.
The last time I shopped at Abercrombie and Fitch, I was probably about 3 years old.
Is that old retail? Is that what that is? I mean, is there like a shelf life on stores like Abercrombie and Fitch?
Well, I am a big one for technology. I love what technology's done to the retail space, and I think that would be one of those older ones that I would say is going to struggle. I mean, going forward, and you know what's important to realize is that we all talk about some people talk about the retail ice age, right? But do you know that the numbers are online retail is only still around 15% of total retail, and we're still having all this carnage. What happens when it's 50-50?
Yeah.
I mean, what does that say for Abercrombie? I mean, those types of stores. So we haven't really gotten into the teeth of the problem yet, and we're seeing a lot of dead bodies. That's something I think that everybody should be aware of.
So it's not really a long-term buy and hold here. So from a perspective of the consumer themselves, okay, when you look at a consumer who feels rich, is it more because their wages are going up slightly? Is it just the overall positive nature of the economy, or is it the stock market?
No, I don't, because I think, only 15% of people own 85% of the stocks, roughly speaking, right? So you can't say the stock market is behind this retail upswing, because that's not going to make most of those people happy. What's going to make most of those people happy, which he's spending a little bit of this goodwill capital, is the fact that they feel more comfortable about themselves going forward. They feel more comfortable about their jobs, and they're leaving jobs and getting newer jobs faster than they have before.
Yeah, that's something people aren't talking about really. The job, not the jobless rate, the job want ads and stuff keep going up, and
Right.
the ability to leave has gotten much stronger.
And I think it's down from 26 weeks to something like 14 weeks if you're looking, right? So it's significantly shrunk, and that's a good thing. So those types of things, higher wages, you don't have to look for a job as long as you used to have to look for a job, and the surety of going forward about what your situation is going to be like are absolutely, I think, behind that.
I'm going to throw a little curveball to Claire back there because she's so good at what she does here. And I'm going to take a quick look at crude oil. Crude oil is kind of sideways. That's manufacturing, that's consumer. Which is it?
Manufacturing. I mean, I'm not a big one about the consumer being behind, or a great economy being behind what the crude market does.
Right.
And also, in the bigger picture, I feel as though we're moving closer to a deflationary environment than an inflationary environment. And these are dollar-denominated products. And if we go into a deflationary environment, I think these things struggle. Gold struggles. Anything that way will struggle. Commodities in general.
Sure. We've got a trade on. We'll be back to talk about that trade, and then we'll go into some other subjects like the other two earnings we wanted to cover. Stay with us. Welcome back, Pure Exposure. You are being exposed. I'm still here with Scott Shellady, the cow guy. Mike Arnold is with us, but also joining us now is Tony Zhang, who is the Chief Strategist at Options Play. Tony, welcome.
Thank you. Thanks, guys.
So let's go right to you because we had some earnings this morning, and I know you were looking at a couple of them now. Before we talk about the actual stocks, tell us what Options Play does.
So we are a financial technology company. We started this company basically under the premise to try to make options as easy and as accessible for retail traders. Our intellectual property is really how we display the option strategies to a user. Instead of showing you a full option chain, which is kind of like looking at a phone book and saying everything you need is in here, just go figure it out. We use visual representation of all of these strategies and apply the best practices to starting points. So instead of showing you every single call that you can trade, we only show calls that typically make sense for most users as a starting point, and display everything in a more visual format and provide guidance through color-coded visual guides, as opposed to looking at the full option chain every single time.
So essentially, you're a consumer-based, retail to a certain degree based, but do you work directly with retail? Do you work with brokerages? Who do you work with?
We primarily work with brokerages that service the retail community. So any broker dealer sell side, either on the self-directed or the wealth management side, are traditionally our clients. But the end user is usually a retail trader or a wealth advisor.
Gotcha. So let's talk about some of the stocks you were looking at this morning. What did you like the most out of the 4 earnings reports we got? What were you looking at, and what would you do with them?
I actually think Dollar General and Dollar Tree are probably the two that stood out for me, because the consumer market is really the market that's been driving this market higher. It's pretty much one of the strong sectors that we're currently looking at, and Dollar Tree and Dollar General have both invested heavily in really optimizing their corporate structure, their retail stores, and they've really this has really started to pay dividends for them. Dollar General a little bit more so than Dollar Tree. And the surprise for me was actually Best Buy. That came in. I think it was the Q3 guidance that came in a little lower than expected.
Yeah.
That took a big ding on the stock. But that was the stock that I was expecting to do fairly well. Versus something like Abercrombie and Fitch, where that, in my opinion, was kind of expected. That stock hasn't been doing very well. I don't know if any of you guys shop at Abercrombie and Fitch, but I certainly have not seen much of that store recently versus some of the other ones. So that if you look at what we saw in Dollar Tree and Dollar General, following kind of in the footsteps of what we're currently seeing with Target, with Walmart, with Costco. So a lot of these cost-conscious retailers, if you will, have been really doing very well versus some of the luxury retailers like Tiffany's, Nordstrom's have really struggled. Even on the private side, Barney's recently, filed for bankruptcy. A lot of the luxury guys are really struggling, but these low-cost guys are doing really well. They've invested in this channel significantly over the last few years that they've struggled in, and really starting to pay dividends now.
Do you see any reason to, and again, your job is not necessarily advising people to get in and out of things, but do you see any reason to buy Dollar Tree to catch up to what Dollar General is doing? Like in the auto parts, for example, let's do home repair. People will buy Lowe's trying to see if it catches up to Home Depot, which it's recently done. Is that something you ever look at?
Yeah, out from a chart perspective, that was actually the one that I was looking at to see if there was some catch up here. I was looking at some options here. Options are still quite expensive. The October 101, at the money calls are still trading at $7-8. So that's a pretty big move to the upside even after earnings. So I do think that it's a little expensive to purchase these call options. Actually, you can buy the October 100 for $6.
Which stock are you talking about right now? Which one?
You're talking about Dollar Tree.
So Dollar Tree, the Dollar Tree options. Go ahead.
I think those are still pretty expensive right now. But that would be the catch-up trade that I would be looking at. But if you look at Dollar General, I actually think using Target as a template, we're really seeing that as a potential runaway trade here. Where Dollar General can just continue rallying, just like Target is, I think is up at 107, 108 right now. That type of trade that I actually think is probably an interesting trade to make. But from a charting perspective, I actually like Dollar General as a catch-up trade. Looking at the price action today, looks a little weak right now. Traded as high as about 104 or so, but really pulled back. So that's a little concerning as far as a catch-up trade. I would expect maybe a short-term pullback to that 100 level or so before I would consider getting long Dollar Tree.
Mike, we looked at Dollar Tree before Tony came on. Let's look at the Dollar General chart, which we'll put up on the screen right now. Do you see anything in this Dollar General chart? Considering, again, 10.1% surprise on that one, 14.5% growth. Street was looking for 158. We got 174. Street was looking for 6.89 billion in sales. I got 6.98. Do you see anything on this Dollar General chart? I think I know your answer to this that makes you want to be involved. Just price action only. Mike?
On Dollar
General.
Dollar
Do you see
General,
anything?
I mean, it's broken above its key major resistance area and actually hit. We had a longer term target of 151.77, which is now trading above. So on anything, if we're looking to do anything, it's going to be based on a pullback to key major support and then looking for a rotation up. And our key major support is back at about 145 right now. So we'll be monitoring that longer term for a pullback and then a rotation up, and that's our signal to then participate.
Scott, when you see a chart like this, like it's stocks, right? So stocks have sort of a natural upward bias just because of all the pension funds and everything that go directly into long only. When you see a stock like this, do you think it's got to come down, or just it's not on your radar?
I would be careful, especially after today's action. I agree with Mike wholeheartedly. If I was going to be involved, I would have to be waiting because I don't like, a lot of times with these earnings reports, these things are binary, right? You either have the position on to make money or you don't, and that's difficult as well. But generally speaking, if you have a nice time horizon and it's a solid company, you'll do okay. And that's, the unspoken thing that we never ever talk about is as long as our population is growing, the stocks are going to grow, right? Because we're going to be giving birth and emigrating in more customers. And so that's something that if you've got a solid company and it's going to continue to perform and you've got a nice time horizon, you've got a good chance of doing well.
So Tony, we talked a little bit about the trade war before you came on, but can you give us your opinion on that? And obviously, I don't think it would necessarily, I think people think that there's more coming from China to stores like Dollar General and Dollar Tree than there is. And they have like a discount model built into their purchases. But what about Best Buy? What's your opinion on the trade war and any of these stocks we've been talking about today?
So, as we were talking, Dollar Tree's really pulled back to that 100 level. Looks like it's reacting a little bit to that level. I actually think that if you wanted to play that catch-up trade, that 100 level is a good time to time an entry, because I would put a stop loss fairly tight below that 100 level. It's bouncing pretty nicely off that 100 level right now. So,
Okay.
Looking at that October 100 call, I think currently, let's see, that's trading at around that October 100 call is trading just
Looks like around $4.
$4. I think that that's a fairly inexpensive way, 450 roughly, inexpensive way to play for a catch-up trade with just risking about 4.5% of the underlying. This thing could rally back up to that 110, 108, 110 level, over the next month or so. I think that would be how I would play this on a catch-up trade.
Mike, you like that pullback level or no?
That's a decent pullback level. There's some key support. We have a key support level right around 98. So anywhere between 98 and 100 could be a good support zone to lean against for any pullback trade. I mean, as I said before, it ran up to one of our targets and now is pulling back. So at this point for us, it's just sit on our hands and watch for the key support to kick in and then a rotation move back up, and then we might participate.
All right, we've got our S&P trade on, so all of you sit on your hands as well. We'll be right back to talk a little bit of Bitcoin. and talking about like earlier in our career. And joining us now is a really good friend of mine, someone who was there for the early years of my career. It's Jack Bouroudjian. Jack, how are you, buddy?
I'm doing great, Bobby. Great show, by the way. I love it, having you and Scotty up there and everybody else. This is fantastic for traders and everybody alike.
Yeah, it's kind of fun. You might recognize Jack Bouroudjian from CNBC. Obviously, I mentioned that the bunch of us have done a lot of TV. Jack got me on TV. So Jack came to me and he said, Jack's very energetic, and he's like, hey, Bobby, the CNBC's looking for a trader that can complete a sentence. I recommended you. So thank you for that. I think I can complete a sentence. But Jack, tell us about what you're doing now. What's your role? What are you into? You're into a million things, so kind of try and keep it to like 4 of them.
Well, obviously I still trade. I do a lot of TV for the CME group. I consult on a few different startups. I've actually started a cloud exchange. But what's really captured my attention and my fascination these days is what's happening in the crypto world, in Bitcoin and in digital currencies. And I got to tell you, Bobby, there are a few times throughout the course of the last 30, 35 years where I've seen these big shifts, and either you catch them or you don't. I was on the board of directors when we created the E-mini concept, and there were a few people that started, capturing the whole concept of electronic trading well before others. And guess what? Now they're all billionaires. And then, so it's really a question of trying to find what I think is that next great thing that's going to appeal to the 83.5 million millennials that are out there. And it's digital currencies.
Yeah. So let me ask you a question, because I've been doing this 25 years now. How long have you been doing this, Jack?
I've been about 35 years now. How about that?
All right. That's good. You beat Shellady here.
Yeah, somebody older than me finally.
Well, and I got Mike Arnold on the screen as well, Jack, and Mike's been doing it 27 years. I may be, Mike, by the way, his Path Trading Partners YouTube channel, he covers cryptocurrencies on a daily basis. So from a perspective of, again, I've been doing this 25 years now, I don't know what to make of Bitcoin. I really don't. Scott Shellady?
I'm more in your camp, and I also look at it from the fact that I was just in London for 2.5 years, and while I was there, I was also the chief compliance officer of the firm I was at. And looking at Bitcoin from a compliance / AML standpoint, it was also giving me mixed signals, or it was a little cloudy and it's still a little bit murky, so we haven't jumped in with both feet yet, for sure.
So Jack, you're the oldest guy on the panel right now, although you look the best, I might add. What can you teach me? Because again, I'm happy to trade anything. I still trade a lot of crude oil. Prior to Bitcoin, crude oil was the most volatile thing you could trade. Now it's Bitcoin. We're looking at Bitcoin now. It's down about 2.25%. Currently, crude oil is doing a little bit differently. Crude oil is kind of in a range. First question for you I have, and then I'll go to Mike Arnold as well. Is it a store of value or not?
It is emerging as a store of value. It is one of the things that it's in its infancy right now as an asset class. But if you believe that computers change the way we actually transmit information and receive information and has changed our lives, which I firmly believe, then I think that we have to take a logical step and start to believe that digital currencies are going to change the way we actually swap value and store value. And I guess I'll leave it at this. Look, there are lots of different things that happen. I'll give you an example. Amazon and Google, when they first came out, made no money. People said that they were absolutely nuts. Nobody should invest in these stocks. Obviously, time has actually proved them wrong. I see Bitcoin and digital currencies, maybe not all of them, because there are a lot of coins out there that I wouldn't want to touch. But Bitcoin, with the 21 million, that's all you have total. And this is, with a few million that might be lost, completely. But if you were to take that 21 million and just compare it to the store of value of gold, which right now at $1,500 is roughly around $10 trillion, if it were to take half of that value or a quarter of that value, each Bitcoin would be worth $250,000. Now, am I saying that that's
the ones
going
that
to
are
happen?
lost.
Well,
why should we be comfortable with the ones that are lost? Like that statement is, go ahead. I'm sorry.
Think about it. They are lost forever. And going back what Scott just said, which is really important, one of the things that really kind of captured my imagination is when the CME group started to launch futures. Remember, once you have futures on Bitcoin, you no longer have regulatory ambiguity. You no longer have the tax ambiguity. You no longer have custodial issues because now you can actually create a synthetic position and be able to manage it properly. I just can't wait for the options to come out because it's really going to give us a kick.
Hey, Mike Arnold, you cover the cryptos. You cover them on the cash side, but we got a CME August Bitcoin futures contract up here, down 2.23% right now, down the last couple of days. We had a pretty precipitous sell-off late yesterday. First question is, do you like, just your personal opinion, do you like anything else besides Bitcoin? And second of all, what do you see on the chart in terms of that sell-off yesterday and where it might go next?
Well, I still like Bitcoin the best because, it's institutionalized now. As we just talked about, there's the futures contract, and it's one of the most prevalent ones out there. We've been actually, I love that it has now the futures contract because we got a Vantage Point sell signal back on August 13th, and it's been a short trade since then. We're watching now for this key support zone all the way down from about 9150 to 9,000 is a very key support zone. We have a lot of clusters in. If we break below 9,000, then we're going to start watching. There's actually a gap in the futures that were left behind since June 14th, which has been unfilled. So we could then see a pretty rapid decline down to 8,500, but that's only if we close below this key support. So longer term, I mean, this is just a very tradable instrument. You mentioned the volatility, which is what makes the trading so much fun, and there's so many opportunities both from the long and short side. We don't just have a long bias only.
Scott Shellady, volatility is fun.
Well, that's what we need to make money, right? I mean, if everything flatlined, they wouldn't need brokers. I mean, we have to have some sort of volatility because we need the market to move.
Does anyone here disagree with me that we're active investors, we're active traders. Jack, you trade the Bitcoin futures. Mike, well, Jack, you trade equities as well. Obviously, Jack comes from an S&P futures background. Again, I've known him for, I've been doing this 26 years. I've known Jack, 26 years. But from a perspective of active investing versus passive, I know Scott Shellady is all about passive for most people. But do we believe, and by the way, I do, that there's a place for active investing, whether it's Bitcoin or something else? I mean, I've always told people 5 to 10% of your portfolio, you could turn your planned trip to the Rockies into a trip to Paris or into no trip at all. And is it a perspective, just a grand perspective should be, this is our particular risk capital and the rest is our investment capital. Scott, I'll go to you first.
Yeah, I think that's absolutely true. I think, you have part of your portfolio is what you would call your investment portfolio, and the other one you can day trade. I mean, there's no reason why you have to only do one or the other. I think that there are opportunities that come up on a daily basis, and there are opportunities that only show themselves once in a while, and those are longer term. So you absolutely, I think, need to have, employ both those strategies.
So Jack, where does Bitcoin fit in on that?
Well, I think that Bitcoin has got to be part of an overall portfolio. We've got to start thinking about it in those terms. In fact, I'm gonna take maybe the other side of what you guys are saying here. I don't really see Bitcoin as a trading instrument.
Interesting.
I really actually see it as one of these things that we put into our portfolios and hold for 10 years. It's just a matter of maybe managing the volatility and trying to flatten it out a little bit, because you are going to get 80% drawdowns. This is a boom and bust cycle as it matures. And if you do believe in the story, then you've got to be able to hang on. And it's one of the hardest things to do, especially when you see these huge drawdowns.
Mike, active, passive, Bitcoin, everything else, what do you like to do?
Well, I think Bitcoin and some of the other cryptos should definitely be part of a long-term portfolio, but they have, from my point of view, they're a smaller part. They're the risk-only capital. As you mentioned, the vacation, you put in some of your vacation money into it, and you might not be taking a vacation that year because it's not something you want to. It's not something you want to go all in. I mean, we saw way too many people on the run-up, a couple years ago, where to 19,000 that went all in, and then it got cut, down around 4,000 again, and they went into that bust cycle because
That's
they had
a
to liquidate
staycation.
at the worst possible time. So it's something that I like to manage it actively and actually trade around a core position, for the longer term appreciation in cryptos. They're not going to go away.
You're killing me.
Just
There's an
have to
apartment in
manage
Rome I
how
want to
you're
buy
going
with
to
my
trade
Bitcoin
them.
investment. You're killing me. The Bitcoin invest, by the way, it's about a 200 square foot apartment. I think they want 18 million for it. So I'm not getting it. I want to go to something before we close out today. And Claire, if you can put up the ES chart again. We're looking at this ES trade that we still have on. You saw us put the trade on. As we continue to develop the PureXposure concept, we're going to show these kinds of things. And this trade is going against us right now. And again, nobody sees me nervous. I mean, again, it's $200 of risk. So how nervous could I be? But that's kind of the point of what we're doing here in PureXposure. All right, and Scott's still in the studio with me here. I want to thank everybody as we watch this trade. We're going to continue to watch this trade. And what we're going to do is keep this trade on because it is a trade that we wanted to put on. We have the risk defined. We have the target. I was hoping we would get to either the stop or the target before the show ended. It didn't really matter to me which one it was, though. And that's kind of the point. And that's kind of the point of the PureXposure Growth Series. So I want to thank Tony Zhang, Scott Bauer, Mike Arnold, Scott Shellady, of course, is still here with me. And I want to invite all of you to come and see many of these same guys in Chicago, September 20th. We're going to have a live event. It's going to be an all-day trading event. Some of the stuff that we talked about here, we're going to be showing you how to do. And one of the key things about the events that PureXposure is going to do is there is no selling from the stage. You purchase a ticket, and that's the last thing you have to buy. If you want to keep in touch with any of these guys, we'd be happy to have you keep in touch. But we really want to see you guys in Chicago if you can make it. You can go to PureExposureGrowthSeries.com, find us there. There's all kinds of information about the speakers as well. If you want to keep in touch with any of the guys that were here or any of the guys that are going to be in Chicago with me. So again, join us. We're really happy you guys could join us today. Hopefully we'll see you guys again. Keep in touch with us on Twitter. You can go to PureExposure MD, and by the way, that's MG. PureExposure MG is the Twitter, and it's one E in there. So it's PUREX. Use a giant X. We like that. We like the way it looks. So find me at Bob_Iaccino. What's your Twitter, Scott?
Scott the Cow Guy.
Scott the Cow Guy is the other one. Mike Arnold's on Twitter. Jack's on Twitter. Jack Bouroudjian, Scott Bauer, Tony Zhang, all those guys. So reach out to us. Tell us what you thought. We're really happy you guys showed up, spent the hour with us. Thank you for being here. You've been exposed.